Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter, look at some things on some information about commodities on Twitter. As you can see, I did get a new camera. It's a Sony camera, just trying it out, trying some lighting out. Obviously, I'm going to change some stuff up, try to get a little bit better quality of cameras and lighting. But we'll go in here, we'll take a look at some things that I'm seeing, some information that people are either worried about or things that I'm, still interested in and watching. So let's dive in. Let's take a look at what exactly I'm looking at, what I've got my eyes set on, and my financial opinions on it. So let's dive in and we'll take a look. So, and if you guys want to follow me on Twitter, it's at finding_finance. One thing I am looking at here is the household and nonprofit organizations, checkable deposits and currency. It's the asset level. This thing's just been, it's been going straight up. And, there's lots of money in the banking system. And I know that people look at savings rates, and savings rates actually unwinding is bullish for inflation. If the saving rates is dramatically going up, it means people are afraid. So saving rates can go down. It can even go negative and go back into this checkable deposits. But I don't know if they're measuring this some other way or what's going on, but this has been growing quite vertically for checkable deposits. We also have loans and leases in bank credit still expanding. And we have, we had a kind of a lull in 2020, 2021 a little bit. Now we're starting to catch back up in terms of loans and leases in bank credit for all commercial banks. That is, the credit in the system. So it is expanding. So that's interesting. I've been watching that. Looking at crude oil. Now here's another thing I've been watching, right? They've got the U.S. president at Joe Biden to release 15 million barrels from U.S. Strategic Oil Reserve, with more releases possible if energy prices spike. I mean, these guys are relentless, man. They really want to release everything they can out of the Strategic Petroleum Reserve. They do not want high energy prices. They probably want to knock down inflation as much as they can. So this is definitely something that I'm watching, is the Strategic Petroleum Reserve releases. I don't think they can stop the move, but they can definitely delay it. And they've been successful at delaying the prices from going higher. But at what cost? At what cost to the Strategic Petroleum Reserve? Here's another one. Kevin Bamborough saying, buyers coming in to gobble up cheap uranium before SPUT can get it. Physical market is doing a breakout. I think this is interesting because we're seeing the physical market get some legs underneath it and start to run higher. So that is something I'm definitely watching. I am a uranium ultra bull. I'm not a perma bull, but I am an ultra bull. I think uranium could do some pretty crazy stuff along with oil and natural gas. I'm still a bull, but short term, we are in between winter, so heating and cooling season, and we might see some selling pressure in oil and natural gas in the short term. Freeport comes back online late November, 85% capacity for the LNG terminal. We also have Strategic Petroleum Reserves starting to dwindle down, but they're looking at potentially increasing those. So that's what we've got in front of us. That's what I'm watching. And I'm not scared. I'm not, I'm indifferent about what happens. I'm fine with it being delayed. I'm fine with getting more opportunities to purchase oil and natural gas companies and uranium if they were to stay down. Now, here's something that I thought was really interesting. And obviously, I talk a lot about this. I talk about harder to get energy, lower energy return on energy invested, and then also declining ore grades. And the combination of all those things. SRS Rock Report says peak cheap gold in 1970 as South Africa produced 67% of the total world mine supply. at a stunning 13.4 grams per ton, compared to the coming peak of expensive gold soon as gold miners are now down to mining gold dust at 1.5 grams per ton. Got gold. And what I want you to take from this is we've got a lot less ore grades that we're trying to go after. And I'm seeing a lot of the new stuff. If you go and you watch some of these smaller companies and these exploration companies dig, they're finding stuff, 1 gram per ton or less. And that's kind of what we're finding to replace. Now, what we have to do in order to pull the same amount of volume out of production from 13.4 grams per ton versus 1.5, you're going to have to be pulling, I'm just going to kind of divide it a little bit less than 2, maybe 5 times as much dirt and tons to get the same amount of grams. So 5 times the amount of earth to get the same amount of volume. That is energy intensive. Another way that you could do it is you could sift through and get the gold dust, more of it per ton. That is something that technology has increased. But I think going forward that we're going to see declining production or supply from a lot of these metals because of declining ore grades. And the energy consumption will go up. So the question that I pose to everyone is, how are we going to hold production high with declining ore grades in an energy crisis environment? It's a good question, I know. Looking here, the nuclear age is just beginning. 50 years from now, people likely won't understand why we wasted decades pursuing unreliable wind and solar power after we already figured out how to generate nuclear, the safest and cheapest way to generate 24/7 clean power. This is our nuclear power generation over time. We obviously had a massive ramp up. We've kind of been dwindling here ever since mid-2000s, but I do think that this will dramatically increase based off the need for more power. So that's what I'm seeing there for nuclear power generation and a nuclear future. Here's one that I think was a pretty cool statement. It says, interesting, many are calling for the end of the energy crisis during the exact time of year when energy use is most benign and inventories are most full. Recency bias is truly amazing. Guys, it won't be October forever. October is usually, it's between heating and cooling season. It's a good time to be looking for companies to be acquiring. And again, that's not financial advice. That's just what I'm doing. And that's where I'm looking for. I'm looking for opportunities this fall to pick up shares in companies that have pulled back quite a bit. It says Goldman out with Commodity Insight report, commodities pricing in a 5.6% decline in global industrial activities, half of GFC '08. Watch for commodity-constrained recession as high COMPX squeezes global GDP equals demand destruction. So what they're saying is very similar to what I'm saying. We have very we fall on common ground here. So let me read through some of this for you guys. Let me kind of see if I can zoom in here and get this in here. So it says 2 years ago, we called for a structural bull market in commodities. For the first 20 months, many elements of our thesis played out, from surging household demand to shrinking spare capacity. Yet today, investors face the most macro uncertainty since March 2020. And I totally agree with that. Balancing Europe heading into recession, the Fed trying to soft land the U.S. economy, and China inching toward reopening. With the dollar too dominant to get long, but fundamentals too tight to get short, how should investors navigate this complex environment? To separate the structural from the cyclical, we introduce, let me see if I can go in a little bit more for you guys. It's not going any bigger there. It says, we introduce a 4-factor pricing framework that explicitly delineates and models each monetary, financial, and fundamental driver of commodity performance. In doing so, we can estimate the net price impact from the recent investor positioning. Flush, a stronger dollar, slowing growth, and supply disappointments against the structural drivers of underinvestment, deglobalization, and the green transition. With a range of possible outcomes for growth ahead, we simulate the impact of hard landing for commodities, noting how, even under such a bearish scenario, structurally tight supply buffers the price impact of a GFC-like fall in demand. So what they're saying is the supplies will be so tight that it buffers you from any sort of GFC-like fall, and we're going to have that demand destruction. Navigating a commodity-constrained recession, as growth slows but commodity supply falls, investors now face the risk of a rare macro situation where commodity demand destruction drives a decline in real activity, or what we term a commodity-constrained recession. Looking back to 1953, we identify similar periods of commodity-driven macro volatility and highlight the specific relationships we expect today. We find that when constrained, commodities are more tied to real incomes than interest rates, with commodities outperforming before falling as demand destruction bites, but outperforming once again as the real income shock fades. Until sufficient investment in production capacity is made, real incomes will likely continue to bump up against physical constraints, creating a periodic scarcity and a persistent state of volatile commodity prices. And they talk about timing the supercycle. We construct an illustrative smart beta strategy from our unified framework, explicitly modeling turning points in commodity trends to give investors a guide on how to time the supercycle. Crucially, we show how long-run investors can outperform by investing, not trading, commodities, buying and holding throughout the upswing of the supercycle, and having a structural short position during periods of growing supply and falling physical inflation. I thought that was a real interesting read there when it comes to that. And they also had some charts there. I'm not really going to go over the charts too much. We've got lithium price. There's no demand issues here. We're seeing deficits beyond 2024 and prices of lithium carbonate to surpass $1 million plus. But lithium's just been going vertical here, guys. Absolutely vertical. Yeah, that's lithium there. And one of some other things I want to talk about that I've noticed as well is let me go back and let me talk about some things that I got right and what I expected in this commodity bull market, and some things that I didn't think or didn't expect to go as fast. So, for instance, this is kind of what I thought, and this is kind of what ended up afterwards. In the beginning of this bull market, I knew that we had, I can show you real quick what exactly I'm talking about. I was looking at the M2 money supply. So during long-term trends, I was looking at this money supply and I saw that they had printed a whole bunch of money, that stimulus money that came into the system. And this is what I saw. I saw a gigantic move in the M2 money supply growth. So we come in here, we take a look at this, and we have a massive ramp up. And this money supply growth on the right-hand side here is inflationary. So we were coming into an expansionary phase of real estate, and they had this massive M2 money supply growth. That was ultra bullish for me. We also had the ratios down in no man's land. They were anomaly levels at how cheap these ratios were, and still are to some extent. That was a pretty easy call because you had very good risk reward and you had the backing of the M2 money supply. Now, as this thing goes on, I knew that the M2 money supply couldn't be sustained at that type of level and that it was going to eventually come back down. The question really is, how far is it going to come back down and what's that sustainable level? Is that sustainable level at 5-6%? Is it 8%? What level is that going to be sustainable at? That's the question. The next thing that you want to ask yourself, or the next thing that I was looking at, so we had the M2 money supply come up, we had everything that was cheap, good risk reward. It was a pretty easy bet. So then the next question I was going to ask is, how fast are rates going to rise? And I didn't know that. I didn't have a good, my interpretation of what rates were going to do is rates were going to come up and they were going to come up slow. The Federal Reserve came out in 2020 in 2021, and they said that they were going to do QE, they were going to hold rates low, they were going to do all this stuff to basically pump the markets. They said that they were not going to raise rates out till 2023, 2024. They were talking about that stuff. And then they were talking about continually pumping the system with this stuff for a good long time. But that's obviously changed quite dramatically. I did not expect the rate of change to change as dramatically as they have done. So when I was looking at it from 2020, 2021, I was expecting, at least going off of what they said, that they were going to hold rates lower and that they were going to basically pump the markets, which they did. And housing, and I'm not going back, I'm still evaluating housing and where it's going. So I got ultra bullish on housing because that's really what was the driver historically. It's the people coming into home buying years, that demographic. They would buy homes, and that demographic buying new homes with new loans is inflationary. Now, the Fed has really reversed their stance, and they are dramatically increasing rates at a much faster pace than what I thought they were going to do, and what at least what they had projected or said earlier in 2020, 2021. The rate of change also was faster than what I thought. So they've gone higher and they've gone faster than what I've even imagined. Now, it is having an impact. It is definitely putting the brakes on the housing market. What I'm watching is the housing starts and seeing what the volume of the housing starts are doing. And what the volume of the housing starts, and we can look it up real quick here, is important because that's where your inflation is. And obviously they're hitting it because they know that. They know that this is adding to the inflation and they're trying to stop it in its tracks. So when looking at this, let me try something here, guys, real quick. I think this is just off a little bit. So this is what I've been watching. We've had a dive down lower and then a move higher. And where is this going to go in terms of new privately owned housing unit starts? This is something I'm definitely watching, and I'm hoping that we get a stabilization somewhere around where we're at. I don't want to see this dive way down. If this dives way down, like 2020, that's when problems can happen. The housing market's a big chunk of the economy. And we don't want to lose that. We don't want to lose the housing market. We lose the housing market, it could get kind of nasty in the short term. So that's one thing I'm watching there. Right now, it's holding steady, and I'm waiting for the data to come out over the next couple of days, probably the end of this week, on housing starts to see what that is. The volume of housing starts. It's the volume of loans against new houses that matters. So that's something I'm definitely watching. I think everybody should be watching that. So that is one thing. I thought the way that I was thinking is that the housing market would get to about, mortgage rates would get to about 4.5%, 5% and really slow down there. Now here's the wild card. Here is the wild card that I don't have answers for. We're going to have to watch and see what's going on. The wild card that I'm looking at right now is what exactly is the Fed going to do, and are they going to continue increasing rates? I think that the rates are holding this all down. The housing market, they're holding the housing market down. They have it contained to some extent, and things could reverse if they continue to go higher. The affordability of housing with the prices where they're at is going to be difficult for a lot of people. And I don't know if we have that many buyers at this price point, at this interest rate, to continue higher. So what I'm waiting for is, are we going to get a shift in interest rates? And is it going to come from the bond market? So I'm positive, but I'm waiting for the data. I'm waiting to see what happens in all of this. I'm not one to be shifting around and moving too fast. I'm looking for the data. I'm looking to see what happens. If interest rates go lower because bond markets are breaking, then I'm going to be positive on the housing market again. But right now, I'm kind of neutral. It's like, let's see what this data gives us over these next couple of months. If the housing starts continue to decline, or if they get hit pretty hard, then you have to say, okay, this could be bigger than what I thought. Now, again, I'm going to be open to whatever the data tells me. I'm going to be open to whatever the data tells me. And I'm not reversing my stance on being bullish on housing. I'm still bullish on housing on the medium term, long term. But the short term, if the data tells me that I should be bearish, then I'll be bearish. We haven't got that data yet, but I'm looking for it. I'm looking at it and I'm looking for it. And we'll see what it bears. But if currencies start to break, bond markets start to break, we're seeing that in England. We're seeing the gilt get hit pretty bad. That's basically gone off a cliff. It's cliff diving. We're going to see the pressure mount in currencies. Now, I think that's going to, I don't think it's just going to be contained to one country. That's a pretty big country. And I think there'll be, we'll call it contagion, where it spreads. So we're going to have to see if they're going to stop raising rates. We're going to have to see if they start buying bonds again. I don't think that they could continue if we see a lot of currencies start to break here. Currencies, bond markets, they are going down, but we could be seeing problems in the system. So that's where I think that we can't just we can't step on the pedal in terms of interest rates, the yields going higher. I think things are starting to break in the system. They broke last time roughly at this area, and that's what we need to monitor. That's the next stage. And there could be good opportunities here for precious metals, especially physical metals, because as things start to get wonky, we could see people start running at it because of bonds and currencies. So that's what I'm looking at next. I'm looking at the housing market, the housing starts. I'm looking at not really the prices, more the volume of the housing starts. And then I'm looking at bond markets and what they're doing and if they're breaking. Now, if we see a reversal of the Treasury go to QE and buying bonds, then it's essentially a pivot. And I think they're going to have to do that. I don't think this is going to be contained just to England. I think it's going to take a couple of months, and we'll see what happens. During that time frame, you could see people get scared. So that's kind of what I'm watching. We'll watch it and see how it plays out together on the channel. And obviously, if you guys like this content, give me a thumbs up and subscribe to the channel. And if you guys need help in looking at companies, getting some high torque companies, definitely check out the Finding Value, finding-value.com. The Platinum membership is the membership I would join if you are interested in that. We do have a Sunday, 5 p.m. Mountain Standard Time question and answer session for Platinum members. So if you are going to attend there, I'll see you there. Bring your questions, and I can answer the questions as best I can. And we'll catch you guys next time. This is Finding Value.